Hi guys, and welcome to another episode. I often say I'm all code and no candles, and I'm occasionally asked what on earth that means. And today I'd like to share with you what that actually means. And it's really about the technical analysis that goes into the crypto investment space. Do you watch videos with candlestick charts and listen to advice on heads and shoulders patterns, top and bottom reversals and cup and handles? Well, I think if you do, you'll be interested in what I've got to say, or at least join in the debate. But first, please like and subscribe. I'm not chasing subscriber counts, I simply refuse to do what YouTube tells me to do. But if you like to think different about the blockchain world and about the sort of crypto herd that is building around that, then I think you'll be interested in what I've got to say. So with that, let's get into it straight away. First, technical analysis is performed on an exchange. So a little bit of history about what an exchange actually is and where they came from, I think will really help understand some of the context that I'm talking about. There is little consensus on when the first stock exchange actually was created, but it was in Europe and it was around the late 1500s with Frankfurt and Amsterdam and the Dutch trading company there. They needed a system for exchanging the new form of securities that were being created, like bonds and things. Now, the first modern stock exchange, similar to what we see today, is I class as the London Stock Exchange, and that happened in 1776, followed 14 years later by the US and the Philadelphia Stock Exchange, with the New York Stock Exchange a few years after that. It all depends, I suppose, on what you think a stock exchange actually is, but the point is, they've been around for quite a while. Now, a stock exchange lists a security, and a security is a representation of what a company is doing. It's the price that other people put on what that company is achieving at that one particular time. And it allows other market participants to buy and sell those. Now, whether you buy a security depends on your view of whether the security is going to go up in value or whether the security is going to go down in value. And there are a few frameworks that help us make that decision. The first of these is fundamental analysis. Now, fundamental analysis is a considerations of a company's intrinsic value based on the product, on the market that product is being sold in, and the management team that is managing the company that is selling the product in the market. Now, looking at a company's product is probably the first port of call when you're doing fundamental analysis. Is it any good? Is it ready for the market? Is it better than everybody else's? Second, you actually look at the market itself. Is there space for the product? Are there enough people to buy it at the price that you've set for it? And the third, arguably, is the performance of the company, well, particularly the management team. What have they done before? How have they achieved before? Have they been successful? Have they done this already? Now, that should be enough, and for some it is. Most notoriously, Warren Buffett, arguably the greatest investor of modern times, is a firm believer in this type of fundamental analysis. How good actually is the company? That will derive how much money it makes in the future and therefore the price of the stock. But there are plenty of other ways of doing this as well. And I suppose the largest one I see in crypto world is technical analysis. You see, the thing is that products, market and management don't change quickly, but the price of a stock does. So why is that? They should be stable, but they're not. So there are thousands of reasons for changes in price, and you can't consume the data quickly enough to actually reflect that in whether you should buy it or not. So to try and predict the changes in share prices when we don't have all of the information, analysts have noticed various, I suppose, patterns that change over time. Remember that these patterns sit on particular exchanges. Now, they don't require news about the company, but they're purely common behavioural patterns of price fluctuations. A quick rise in price is followed by a quick dip in price, and then followed by a small price rise and the equivalent dip size in that. That's called the head and shoulders pattern. And this is all grouped into something called technical analysis. Now, technical analysis has been around for as long as stock exchanges have been around. And a lot of technical analysis is based on the candlestick chart that you see and we see regularly in the crypto world. Now, this was invented in Japan in 1755 by a chap called Honra Munizer, if I think that's how you if I pronounced that correctly. He did this on rice futures. He wanted to know when to buy rice or pay for rice and have it delivered later and get the best price out of that. Now, since that time, analysts have built a whole bunch of these patterns, a whole series of these patterns on kind of repeated shapes on the candlestick chart, such as head and shoulders, cup and handle, and support and resistance lines. Now, they weren't all created at once. These have formed out of hundreds of years of behaviour of stock markets, with the changes that the stock markets have seen, the complex interplay between countries and changes in regulation. And you should hold that thought. Now, these patterns are very useful in traditional stock markets. Many companies make a lot of money from applying these sort of patterns and techniques in their trading activity. But this is a particular environment, hundreds of years old and built on hundreds of years of interplay between consumer and buyer, product and market, and country and regulations. Can we really take patterns that have formed from that world and translate them wholesale into a market that is 9 or 8 years old, with a product based on nothing, changing regulation on a monthly basis? I suppose my answer is no, and for two what I think are good reasons. First, and most importantly, it is pretty obvious that crypto exchanges are artificially trading so that their books look bigger. It's a financial incentive for them to do it. The larger the exchange, as in the number of trades happen, it looks more like they have liquidity. The more liquidity they have, the more people will be drawn to their exchange. The more people are drawn to exchange and trade means the more transaction fees they have. They are not regulated, so we have no guarantee that the financial incentives aren't affecting their behaviour. They may be adding pretty badly. And there is a great piece by a chap called Sylvain Ribes on Medium that it looks at the trade behaviour of regular actual exchanges and the crypto exchanges and see what the real differences are. Now, if the maths by Sylvain are to be believed, it looks like around 93% on crypto exchanges, particularly OKX, which is the largest crypto exchange, are actually fake. That means that there are only around 300 million transactions or 300 million in trade volume over 24 hours. And you compare that to London Stock Exchange, which is about 5 billion USD per 24 hours. Obviously, if the trades are fake, then there is too much noise in the data, and it's impossible to separate fact and fiction. So how can we apply these patterns? And this is why we need regulation in the crypto space, regardless of all its flaws. Regulation at least forces some honesty because you can be checked at a later date. Now, secondly, I'm not a specialist in technical analysis, so like the vast majority of people, I have to look to other analysts for that advice. And there is a definite feeling of amateurness that is overrunning the YouTube and blogs world. Now, I don't mean to be disparaging to anybody in particular, but it does seem to be a pattern that we're seeing. Amateurs suffer from a few issues that professional environments don't, that they have solved, that they've baked into their team and management structure. You know, through training, through checks and controls, through management and the middle office functions, there have been literally years of support around removing problems and making everything act more professionally. Now, what are these problems, you may ask? Well, it's all down to patterns. Now, humans are pattern machines. We tend to group things together and apply judgments based on that group. We then do heuristics or shortcuts to thinking to make our decision-making more efficient. And these shortcuts are where the problems are. They're the biases that we have. Now, there are two very big biases that I think applies to amateur analysts, that there is no way that they can sort of get over that unless they're very good at their job, and obviously some are. Now, the first is the clustering illusion. Now, that is looking for patterns in random data. And the second of those is confidence bias. Once we've found the patterns, we see the patterns that we've spotted before in other exchanges and other trades, and then think they're important this time. This all leads to big problems, and as you can see, there are probably too many problems with technical analysis in the crypto space today to take it as a reliable system. But those are just my thoughts. So let's wrap up. Stock markets have been around for hundreds of years, and they've grown along with the countries and the regulations that have hosted them, and they've been moulded to particular ways of doing business. Other factors have taken into account, such as globalization over the years. All this is kind of baked into the big picture. Now, these markets are a world to themselves, or at least a model of that world, and models have patterns of behavior that are recognizable, and we use a technique called technical analysis to recognize these patterns and predict price movements so that we can make choices about whether to buy or sell. Now, we often see technical analysis lifted from real exchanges and then applied to the crypto exchange world, but I feel there are lots of problems with these. First, the world model of regular exchanges is not the same model as a crypto exchange. And so how can we actually apply the patterns that have been built over the years to something that is essentially brand new on a product that kind of doesn't have real world value yet? Secondly, I simply don't trust the data from the exchanges. They are not regulated, and they've financial reasons and incentives to be the biggest exchange out there in terms of trade volume. So the actual trades we're basing our patterns on are just not real. And finally, the analysis that I see from others, it's particularly on YouTube, it's extremely amateurish, and it's not to the professional standard that I would expect and that I would have trust in. So we have to take what they say with a pinch of salt. Anyway, I hope this has helped you think at least about the subject. And if it has, please like and subscribe. It really helps other people find this content and join in the conversation. So, I'm going for a swim, and I'll see you next Tuesday.